Good evening again. My name is Andrei Gushin. I'm chair of Venture Lab, and we're glad to have you here. Venture Lab mission is really simple. It's to help entrepreneurs succeed. And we teach you how to plan, fund, and operate profitable company. Today, I have a special guest in this room. We have a delegation from Mexico. It's Technology Business Accelerator, sponsored by Ministry of Economy. And person who is in charge is Itsam de Gortari. So please join me to welcome this delegation. And hopefully we'll have some fruitful collaboration between Seattle and Mexico. Just to want to bring your attention to next Venture Lab event. It's March 1st. Meet the Angels. This is annual and very popular event when 7 angel investor clubs from around Seattle come together to this room to tell you how they work with entrepreneurs, what they're looking for in business plans, how much money they can give you, and what they want in return. Now it is my pleasure to introduce our distinguished speakers, Sujal Patel and McIlwain. Sujal is a CEO and co-founder of Isilon Systems, and Matt is a venture partner of Madrona VC. Isilon's story is really remarkable and can teach us a lot how to be successful and also how to weather trials and tribulations along the way. Please help me welcome Matt and Sujal to the program. Thank you for coming tonight, and I hope to see you in March.
As Andrei said, I'm Sujal Patel. I'm the founder and CEO of Isilon Systems, which is a company that was formed in Seattle just about 11 years ago. And we have an interesting story to tell you. It's a story about a company that started from modest roots like most do, which went through a pretty successful path through an IPO, and then ultimately 13 months ago sold for $2.5 billion to EMC, which is the largest data storage company on earth. And unlike what you might read in the news with respect to LinkedIn and Groupon, Google, most companies don't just have linear straight paths from the beginning to some huge success. Normally there's huge bumps in the road, there's challenges, and hopefully Matt and I will be able to share with you a little bit about our story, and hopefully you'll have something to take away from it. Maybe Matt, if you want to just take a second to introduce yourself too, and then
sure.
Get going.
A little feedback here. Matt McIlwain, as was mentioned, I'm one of the managing directors at Madrona Venture Group, and we do early stage venture investing here in the Pacific Northwest. About 40% of the time we invest at a seed stage, and 60% of the time we invest in the first venture round. In a lot of respects, Isilon was kind of a tweener. It was, in respect to the team and what they'd done at that point in time, it was pretty seed stage. And in terms of the capital that was needed to get the company going, it was more of a first venture round. And I'll turn it back to you to kind of pick up on this story. It was actually 11 years ago, probably to the day, that we first met in February of 2001.
Probably right. Wow.
There you go.
Well, that's auspicious. What do you know? So maybe I will pick up the story there. I should back up a little bit and kind of talk through my background as we get going. I graduated from college in 1996, and I grew up in New Jersey. Can't tell by my accent, hopefully, but I escaped. And I came out to the West Coast in search of high technology companies. Joined a company called Real Networks here locally, and started as a software engineer. And always in my blood, in the back of my brain, was wanting to start a business, wanting to really innovate and build something from scratch. And I spent about 4.5 years at Real, built the teams that ended up building their back-end infrastructure technologies. And while I was doing that job, and I was building the servers on the back end and the network infrastructure that actually go and powered streaming media innovations on the internet and in audio and video, one of the things that we realized was that customers that we were selling to were not just struggling with how to build streaming media infrastructures, they were really struggling with storage infrastructure scaling effectively to deal with the fact that media was much, much bigger than traditional text-based data that they used to store. So it used to be they'd store your name and credit card information, some information about an airline ticket you bought. And now companies were dealing with storing hundreds of hours of video and images, and the strains that it put on storage systems really began to show. And out of that problem statement was born an idea around building a completely new storage architecture based on the principles of distributed computing that would scale much more effectively. And in October of 2000, I said to myself, boy, that vision is too compelling to pass up, and I decided to quit my beautiful job and start a company. October of 2000. How's that sound for timing? It was not so good, you know. And you know, I have the usual stories that everyone has, right? I left a company when the stock was just coming down from 100 to 30, and I said, hey, let's hold on till January, and then we'll sell that stock then. It was at 8. Oh well. But all in all, you know, October, November, December, I thought about the idea, really found it compelling, started working on some of the technology behind it, brought my number 2 guy from my previous job on board as a co-founder, and really got a new venture off the ground. And you know, that in and of itself was a whole process. It was a process of figuring out everything from how am I going to attract capital, what am I going to do to get office space. It was really from the very beginning. And out of that, we ended up, one, starting to network in the local community and understanding how we could get access to venture capitalists in order to raise money. And then 2, we began some of those early meetings in January. And as Matt said, I think our first meeting was probably just at around 11 years ago in February. And you know, one of the things that is unique about our business plan, and it's a testament to Matt's foresight that we were able to get a funding round done, given what we knew about the business. But we were in a very capital-intensive space. In order to build a storage company, it roughly took $100 million. Many companies $200-300 million, and you have to get started with quite a bit. Right? There's a lot of stuff to build, a lot of technology. For us, we really had to ramp up to about 40 employees in the first year just to get going, and it would take us 2.5 to 3 years to get a product out. And so we put a plan together around that, and we went out to the local VCs, we went out to Silicon Valley, and we started talking to venture firms. And maybe I'll pass it to Matt to talk a little bit about what that first meeting was like and why in the world you gave me $8.5 million.
I'm still wondering. Well, you know, as Sujal, and there's a couple of context things that I think are useful here, and it's part of why, you know, being invited and participating in an event like this is a really a pleasure, because you know, part of what makes the Seattle ecosystem great, it is an ecosystem. And so you hear this story. I mean, Real Networks wouldn't have been here if it wasn't for Microsoft being here in all likelihood. And Sujal wouldn't have come out from where he was working on the FreeBSD kernel as an undergrad at University of Maryland in the computer science department, getting his computer science degree, unless there was a company like Real Networks that was happening to use that same, you know, Unix version to build their back-end server technology. And so really having this ecosystem that, you know, now there's been, you know, actually a few teams that have left a while ago from Isilon and started businesses. No doubt over the decade ahead there'll be more. You know, that's the kind of thing that is really important to, you know, all the potential that we see in Seattle over the next decade. But at this point in time, 11 years ago, you know, you'd be surprised how infrequent people come in and visit with us, and they don't start talking about the customer in the first 10 minutes of the conversation. And if people aren't talking about the customer that they're thinking of and the customer's problem in the very first set of minutes, I'm usually pretty concerned that they've got an opportunity to build a great and compelling business. You know, sort of a philosophy that we have, and few of you have heard this before, is there's some customer-driven problem, and there's some set of big picture trends that are allowing that customer-driven problem to be changed and solved better than it ever has been able to be solved before. And then thirdly, you happen to be a team because of your life experiences that you can do something about actually building and delivering the solution that's going to win in the marketplace for that customer-driven problem. So let's take that framework and apply it to Isilon. Here were Sujal and Paul that were delivering this server-side technology to folks like AOL, and AOL had some storage that was just being crippled under the weight of these big files, these big volumes of files, these different patterns of how those files got used, i.e. read versus written. And they came in talking about that. And on top of that, they said, we think that there's this whole shift in, through using some really innovative software, distributed file system, that we can build in the software the robustness so that we can use commodity appliance boxes and commodity disk drives to deliver an enterprise-class solution to solve that problem better than any way it's ever been solved before. Now, before you say, oh, gosh, that seems easy, you do have to keep in mind there were over 200 storage companies funded between roughly 1998 and 2001 that thought they were in some form or fashion trying to solve problems better than anybody else had in the world because they had some innovative take on storage. And so we spent some time, in fact, I think you might remember meeting with Hank Levy, who's the chair of the computer science department, Steve Gribble. Hank and Steve actually ended up being a part of our initial technology advisory board for the company. And so we triangulated around, can these guys really do what they said they're going to do? We went and talked to our friends at Real Networks that knew them and worked with them. Are these guys the rock star architects and engineers that are leading the innovation on your server-side technology? And then we did our own checks on the trends and our own checks with customer types. And we got convinced that triangle, the framework I was laying out before, applied to Sujal and Paul. And from that February meeting, dug in, and I think by early May, had co-led around with Atlas Ventures. Atlas Ventures had, at the time, an office here in Seattle. Laura Jennings, an absolutely wonderful person, had been at Microsoft for a number of years. She and I, co-led that round, and she and I joined the board at that time.
That's right. It's interesting. One of the, I think, important lessons that we learned very early on in the company was due to the fact that we had to go out in an extremely difficult time and raise money. By the time we got to January of 2001, which is when in earnest we really started thinking about raising money, and not just raising $1 million, but raising $8.5 million, it was basically at the point where all investments in the venture community had come to essentially a halt because the dot-com bubble had collapsed, and every venture capitalist we would talk to is inwardly focused trying to figure out how not to lose all their money in their portfolio because they funded the 33rd pet.com company on the internet. And so it was an extremely difficult time. And I think that for those of you that are entrepreneurs, are going to be entrepreneurs, aspire to be entrepreneurs, there are lots of different experiences fundraising. Howard Schultz had the experience when he went out and said, I'm going to go sell coffee for $3, that everyone would just throw him out. That's ridiculous. How are you going to sell coffee for $3? The same sort of thing, that same sort of story you hear countless times. Ours was a different challenge. Every time we would go out and tell the story, there were some like Matt who really latched on to the exact problem that we were trying to solve and really believed in us. But most of the time, and we opened up 50 VC conversations at the same time in order to get that round done, most of them would say, that sounds just like that company and that company and that company, and one of the 200 that funded storage startups that are out there. And one of the first lessons I think that you learn as an entrepreneur is really around perseverance. Whether you're raising money, you're trying to hire up a team, being an entrepreneur it seems like a lot of times it's about a lot of little failures. It's bouncing back from every rejection, every difficult conversation that you have. And some of these VCs that we talked to were actually quite interested, but had one aspect they couldn't get over, and you might meet with a VC 8 times, 9 times, or in the case of one in Silicon Valley, over a dozen times, and the conversations actually don't actually lead to a successful investment. So you've really got to persevere. You really have to be focused. And one of the hardest things, entrepreneurs have a lonely job. It's putting on a good face when you go back to your employees and they go, hey, how'd that meeting go? You're, oh, that was great. I mean, this is going to be easy here.
Well, it's interesting. Sort of two things that come to mind when you mention that. I mean, one is, I probably don't fully appreciate how much, people say that a lot of times there's sort of skill involved with this, but there's also a lot of luck involved with it. And, part of the luck, I guess, in retrospect, was that Laura and I were relatively new venture capitalists. This was the second investment as a venture capitalist I'd ever made. And the first one was Performance. Some of the people in the room know Performance, a wonderful spin out of the University of Washington, and it worked out well. But I only had one other deal, only one other board I was on. And so I had a little bit more time and bandwidth to maybe take on some of the risk. Plus the fact, and this is where our core conviction is, early stage ventures a local business. And you'd be amazed how many just terrifically, far more talented investors from the Valley won't do a deal at an early stage up in Seattle because they're going to have to get on their plane and fly up here. That's a lot of hard work for them.
Their plane.
I know. I was very careful about that. Their plane. That's just too hard. So, so anyway, I think there was some luck involved with that, and I think same for Laura. I think it was Laura's second investment as well.
Yeah.
And
it's interesting you bring up this part of the story. There was a third investor we left at the altar, brand new partner. This would have been their first deal.
Yeah. So I guess there's a little bit of a insight in that about it's not necessarily the case that now 12 road mile years worn later that somebody, quote, with my experience in venture investing is going to be the right person to win over within a venture firm. In many cases, it's going to be the younger partner or the younger associate that if you can kind of advocate to them and get them enthusiastic, and if hopefully it's a semi-functional venture firm, they should have as much respect and kind of sway at the table around the venture table if it's a true partnership as anybody else at that table. And so it's not necessarily the case that somebody like myself nowadays, 12 years later, is the, quote, right best person to be talking to initially. The other dimension of it is, you guys had, you had a long road ahead before you even had a first product out. And so quite a bit of the rolling up our sleeves in those first 18, 24 months, and I'll let Sujal fill in a lot more of the blanks, was, the job of a founder is always chief sales officer. Whether it's raising the money, as Sujal was talking about, and by the way, salesmen get told no a lot of times. Recruiting the right people, recruiting the right, or good fit, early customers that are willing to, in this case, bang on some boxes and figure out the flaws in it. And one of the things that attracted me to Sujal and Paul was that they had a way to sell their vision, their capability set, not just to me, but to employees as well as to potential customers and partners. And I think that made a real difference. It's funny. I mean, I think we're still good friends with Troy, some of the guys. There's some stories we could tell, that were some of our earliest customers and earliest employees in the company. There's a few of them actually in the room today.
Yeah, there are quite a few actually. It's interesting. We should pick up on some of the threads that you just talked about. I think just before I move off that point of perseverance, just some more of the numbers around this, right? So I mentioned, the worst of the VCs took 12 meetings and never got anywhere. Never even got close. Some of these meetings were hours and hours long. We approached 50 VCs simultaneously. Out of those, 40 took a first meeting. That initial set of introductions, which we did simultaneously, all over email, all via a personal reference, not one of them was cold. And those led to conversations that essentially consumed me 100% of the time for 8 straight weeks. So 8 straight weeks I did nothing but spend 3 days a week in Silicon Valley, 2 days up in Seattle, and did nothing morning to night other than do pitches. Paul, who you mentioned, is the co-founder of the company. Paul essentially was responsible for everything else, while that was everything that I did. And that's what it takes often to get an idea over the line, to get the right match between an investor which has common vision that you do. And it's important to find the right investors, right? Investors are critical both for their capital, but also for their networks and their advice and so forth. And Matt and the early investors that we attracted really were instrumental in our company's growth and success. So let's fast forward from here. Yeah. By April, we had a term sheet to raise $8.5 million, 8.4 to be exact. We closed that round at the beginning of May, and we started hiring people rapidly. By the time we closed that round, we had 10 employees. All that initial money was all that money that I thought I'd have a lot more of after Real Networks. That all fell down to $8 a share, but took it all, rolled it into Isilon. That's what entrepreneurs do. And we were up to 10 employees, and we had to hire about 30 more through that year. And as we started to think about that hiring, it was not just hiring engineers, it was hiring someone in strategic marketing to help really think through the positioning of the company and what our market entrance strategy looked like. We were going into a market which is dominated by a few entrenched competitors, all with billions of dollars of revenue. And so we needed to come up with a go-to-market strategy that really was very, very focused and really was able to target the market in a very specific way. And I'll get to that in a little bit. One of the points that Matt brought up is that the entrepreneur's job is a salesperson's job, and with recruiting, it can't be more true than with recruiting. For many of those jobs that I mentioned, it takes a very, very long time to find somebody who's the right cultural fit, who has the right energy level, the right work ethic, and the right skill set to be able to be the right person for you to spend 16 hours of your day with building a company. The VP of marketing position for us is one of those examples. I interviewed, at least if I add up phone screens and in-person interviews, I interviewed about 100 viable candidates before we went and hired someone on that job.
Well, and I think the irony of that story too is that the guy that we ended up hiring,
this guy I knew from the past,
and it was actually somebody that I think, if I remember the story correctly, I was like, you should really take a hard look at this guy. And you're like, no, I know Brett from real. You really, are you sure you think so? And we had a good back and forth on that, and you kind of met him, and then you met some more people, and. So I think that's an iterative process too. One of the hiring the right people on the team is such critical leverage, not only for the CEO, but really for the investors and partners around the table. I mean, there's really only so much that we can do, and part of that is hopefully asking good questions. Part of that is helping to be an adjunct salesperson, whether it's opening a door or trying to close a candidate. That's coming, taking all the risk of joining a funded but going cash flow negative quickly, early stage company, and it's just such a critical leverage point. In fact, the other thing that's critical is pointing out when maybe somebody is not the right fit, and we had an early business helper guy that wasn't the right fit, and that was a hard thing too because he wasn't the right fit, and we had to move on from him. Good guy, a lot of respects, but just not the right fit for what we needed in that first year of the company, and we could kind of tell that.
And we moved quickly on that, right? I think there's a
move
lesson there, right? Which is
yeah.
hire slowly and be careful, fire fast,
yes,
right?
Absolutely.
Which, it's in a startup you have to do.
But Brett came on board. He was really our first, kind of dedicated business executive, these guys were plugging away building the product. The challenge was it was expensive, long lead time product to build, and so and the macro economy didn't get any better. This was of course May 2001. Then there was September 2001, and while we had capital in the bank and we're plugging away on building what became the 1FS file system, people were buying less and less out there in the marketplace, and it was really even hard to just get people to be considering being alpha customers for us.
Yeah. I think one of the other important lessons that I've learned, not just from this hiring experience, but hiring experiences afterward, is that oftentimes in a startup, your thinking is not parallel with the traditional thinking of your competitors, especially if they're older, more entrenched companies like the ones we compete against, like IBM or HP or at the time EMC or companies like that. And so, really much more important than the skill set and the experience is the cultural fit, the ability for you to connect with somebody and know that they're incredibly smart, they think like you do, they're passionate about what they do. I interviewed countless people who came from infrastructure, who built storage products, who've been at those large companies, and none of them were the right fit. Brett was a guy, he was in an internet company with me, and before that he was at Call Cellular as a product manager. Before that, he was a management consultant.
I know, that's really dangerous.
I'm
a recovering management consultant.
Recovering management consultant. Completely not the profile I was looking for. But what did he have? He was culturally similar to the culture we were building at the company. He was a guy who was going to be there in the trenches with us, working 24/7. He was a guy who was a storyteller, who was incredibly passionate. And he was somebody who was very smart and analytical and could help us really refine our business. And I found those lessons to be true for the next decade after this point, which is much more than the experience of the person, the skills, is how well they fit with the team, how energetic they are, how much how much they've been able to adapt over time, and how quickly they've adapted. Those softer skills were absolutely critical.
Want to talk about Series B?
Well, let's get there. So we got to about 40 employees by the end of year one. They're now in January of 2002, and we were going to kind of grow from here till about 50 people. Mid-year, we had to raise the Series B. We're a little behind on our beta version of our product, and it didn't work.
Maybe a lot behind.
Didn't work so well yet, but we had a good story. We went out and we actually pitched relatively few venture firms, and out of those venture firms, one of them that we went out to pitch was Sequoia Capital, and many of you know Sequoia is one of the top 3 or 4 venture capital firms in the country by reputation, and a firm that we would have absolutely been right on top of in Series A, except for the fact they invested in a little company called NetApp, which today does $6 billion in revenue and owns the entire market that we'd like to take. That was a problem, but it turns out, I don't even remember the exact story. I know you were instrumental in making that introduction. I don't remember what the exact
I knew somebody at Sequoia, and I was talking with her about this great company I was working with, and that we were thinking about raising a Series B. And she said, oh, there's a couple guys in our shop that are really looking at that space of next generation storage companies. We had a big success with NetApp. It's public. Don Valentine's on the board. He's one of our more senior partners. And so I said, well, gosh, I'd love an introduction. So I got connected with this guy, Greg McAdoo. And Greg turned out to be the guy that led the deal. Once again, I think that was maybe his second deal.
Yes, it was probably his. I think
second?
Yeah. He had a few boards. He took over a few, but that was his second deal.
Second that he led. And so it was interesting because he, I hadn't known him in the past, but through that connection. And as an aside, it's interesting to hear you talk about this kind of going out and talking to 50 VCs. And I do think to get that first round of funding, sometimes you need to get a lot of no's, whether it's from angel investors or venture capitalists or the combination of the two. I guess I kind of come from a philosophy that beyond that round, it's better to really have a tighter screen. I think it's very hard to manage any more than 6 to maybe 8 firms that you're kind of really considering, and they're considering you on a concurrent basis. And so developing a list of maybe 15, and then trying to prioritize that and saying based on the firm, their experiences, the people specifically, the culture fit, maybe the past experiences with the venture firms or the other angel investors that you've worked with, really trying to narrow that down and go after a sub-target list. And we went through that exercise.
We did, and that is absolutely the right strategy for B as well. Yeah. By the time we got to 2002, most of the VCs had gotten their heads out of the dot-bomb shelter, and they were just pulling out and started to make investments again. It was a little easier. Mm-hmm. The Series B for us, I think, took 30 days because it was a very condensed list of folks we went after. And once Greg met with us, I think we were in front of another one of his partners within maybe 2 business days, and then within a week or 2, we were in front of the entire partnership pitching. And Sequoia was very interested, even though they'd seen 250 storage startups, because they had a common vision for how storage industry would evolve, the products that we were trying to build, and really connected with the team. So once again, that's sort of that cultural fit between investor and really founders in this case, but then by extension company. And the partner pitch was one that was really quite interesting for us. We went down there, we walked into the room with their partnership, Don Valentine, who is founder of National Semiconductor and something else.
On the board of Cisco, right?
On the board of Cisco, on the board
NetApp.
of Apple,
Yep.
on the board, and the first institutional investor in NetApp, which eventually, today does $6 billion in revenues, worth, something like $30 billion in the market, 20 billion, something like that.
I don't think it's 30.
The stock's fallen a little.
Yeah.
It was for a little while.
Yeah.
But Don's sitting in the back of the room, and I get in 3 slides, and Don raises his hand, and I look back, I'm like, yes. Don says to me, do you know who I am? I go, yeah, Don, I know who you are. He goes, and you want to show me this? And thought about it for a second. I said, yeah, I want you to see this. And we did an hour-long pitch. We got to the end of it. Don was a huge advocate of doing the deal, sitting on the board of NetApp. And it's interesting. having an investor that was so closely tied to our #1 competitor, we, for years and years, had so many of these interesting dialogues, so many interesting paths that were weaved. But you know, Sequoia led that round. We raised another $15 million. So here we are. We're in $25 million, and we still don't have a product at all.
I'm starting to get a little nervous at this point.
That's getting a little nervous, but you know, somebody else led the round.
Yeah.
Okay, continue along here.
Yep.
And you know, that was the round that was going to take us to our first product to get us out the door and try to meet those lofty revenue projections we showed you.
Yep.
And we got to the very, very end of the year. We got our first products out to the marketplace, and we got our very, very first few customers.
We hired a couple more terrific people. One who's sitting here in the room, and another who was our first and for the longest time only VP of Sales, a guy named Eric Schollard, who lived up here and had worked for Veritas and knew the software industry and the storage industry. And you know, he was one of the big national account guys for Veritas, and we were able to remember. I think Laura went to his house and talked to Jill and kind of helped talk Jill into saying, "Yeah, you know, this is a good move for Eric." Jill's Eric's wife, and it convinced them to have him leave this, you know, really high-powered, big-paying job at Veritas and take the risk with little old Isilon before we had $1 of revenue. And I think that was December 2002.
Yeah, and you know, that was, you know, hiring Eric was no different than the sales cycle we had with Brett. It was a long, drawn-out process with a large number of interviews. A big part of our attraction to Eric was not only his skills and cultural fit, but that he was local. You know, I'm a huge believer that that teams need to be local when you get started at the early stage. You know, today at the scale we're at, our execs are scattered all over the place, connected with telepresences and phone calls. But in the early stage, building that mojo, building that team dynamic, you know, going through a long day at work, going out, having that beer at the end of the day, those things are critical. And Eric was able to do that because he was local. And there are very few people in the Seattle area which have done enterprise sales and infrastructure at the scale that he has, in particular in storage.
Well, yeah, and back then too, I think it was really hard to recruit people. I think this is a big change over the last 10 years in Seattle. Back then, it was really hard to recruit somebody in the enterprise software, enterprise systems, enterprise storage side, because the question was, gosh, you know, if this company doesn't work out, you know, who am I going to go to work for? Well, now in the cloud era, I mean, I think you could make the case that this is the cloud capital of the world. You got Amazon, you got Microsoft, you got the CEO of VMware, you got the Citrix team.
You have our weather.
You got the weather, it's cloudy. You know, you got a lot of cloudy stuff, but you know, that really helps now, and it helps with recruiting. It was harder back then, and I think there was a big premium on finding somebody that could be on board. And you know, you can extend it to customers. You know, Loud Eye was a beta customer. Did they ever buy from us? I don't remember.
Oh yeah, they paid us.
Okay, good. And Troy, well, you get the naming of the company story.
It's already in the past. That's an interesting
and Corbis was actually our first paying customer.
Corbis was our first paying customer. That's right. And you know, back to the whole Eric story. You know, the big part of that recruiting cycle as well was convincing him to leave his high-powered job. It required. You have to really connect with the person. You have to get them to believe in your vision. You have to take the wife out to dinner, get her to believe in the vision. We involved Matt. We involved Laura Jennings, who was on our board, and it was our other large investor at the time, or I guess one of the 3 largest investors at the time. We really had to surround him, his wife, and convince them that this was the right opportunity. And you know, that's critically important because, as I'll talk about, you know, the path after this point's not really linear, and so you need people to be able to breathe deep and say, okay, I made the right decision, and be in the trenches with you.
Yeah.
So we got our first products out, and we got Corbis as our first customer. UW Medical was the first paying customer. You missed them. That's right. Corbis was the second.
Yeah, UW Medical was a smaller deal, though.
A few other young ones, and you know, actually, maybe before we pick up on this story, I think it's probably a good idea to talk about sort of what our focus is at this point, because I think that's an important part of it. You know, we're now in, we're in the beginning of 2003. By this point, Brett Goodwin, our head of marketing, has been at the company for 18 months. And myself and Brett, while we were building these products, have been very focused on trying to figure out how in the world are we going to go and take these products out to market? Where are we going to go to sell these products? Because if we do what all these other 250 startups did, we'd go out there and we'd climb the highest mountain with our megaphone and we'd say, we built a better storage product. Come.
I think project is actually the right word.
Project. And you know, there were a few companies at this point whose names, if I said them to you, Cereva, Trusan, their companies don't exist. You've never heard of them. But they raised, in Cereva's case, $250 million before they went bankrupt. You know, these are companies that attempted that. And what we decided to do very early on was we realized, one, that we were going to build a product that would get out in a version 1.0, but would be very, very feature poor. And so we would need to target it to a very specific narrow niche where it could succeed. And we also realized that we really had to build concentration of customers in particular use cases, otherwise we would never be able to win at this. And so we decided when we went out that we would only go after really just two types of companies. We'd go after companies that had, you know, big media stores. Those were traditionally web companies, Web 2.0 companies, and we went after media companies, companies that were producing films or broadcast television companies, you know, major movie studios, television stations, and that was it. And that was the real strategic focus. And yeah, we picked up ancillary customers along the way, but we went out with a really, really tight focus strategy, and that was absolutely critical because not only were we able to create referenceability within those small niches, we were able to fine-tune the feature sets to just the bare minimum that was necessary for those niches so that we wouldn't have to spend $100 million and build every feature and then figure out we had the wrong ideas. We were more agile. We also were able to start to learn markets and just outmaneuver our competitors because we knew a market better. We knew when I talked to a web company, I knew what their applications were. I knew where their pain points were, and so it really enabled a much better strategy as we got out.
Yeah, it was a focused, best-of-breed play, and there were a whole set of, I like to call them the abilities.
Yeah.
You know, there were a whole bunch of enterprise abilities we didn't have, and we knew we didn't have them, and it was going to take a lot of dev resources, a lot of time to get to those. You know, one of my favorite ones is this capability called snapshots. Maybe you should tell that story.
Oh, go ahead. You can tell it.
So this is a capability where you can snapshot something. It sort of is what it is, and it was one of NetApp's big competitive differentiators. And they upsold it as a separate software module. You had to pay extra for it. For years, we talked about how we got to get snapshots. We got to get snapshots. But the customers we were going after, they didn't really want snapshots. And when you kind of talk to them,
it's not that they didn't want it. We could convince them that they could buy without it.
They didn't need it. That's a better way to say it. That's a better way to say it. They would like it, but for what? They were in so much pain with these big files and managing these big volumes of files that they would rather have a solution like we had than pay for something with snapshots that didn't do the things that they absolutely desperately needed to have done at a price point they could afford.
Another good story is how many of you have a network storage box at home? Like something that you plug into the network and it's a network drive. All right, I counted 10 hands. What happens when a disk drive fails? It's not so bad, actually. You swap it out, you put it in. It has built-in redundancy. Well, for the last 20 years, every product in the enterprise and storage space, when a disk drive fails, you just pop it out and put the other one in, and really nothing. It's called hot swap. You hot swap the disk drive. Well, it actually turns out in the architecture we built, that's a hard piece of functionality. And had we known anything about the storage industry, we would have said there's no way we could sell this product without hot swap disk drives. And in fact, our first systems engineer, who a couple of people in the room know, stood on his head and told me that it would be impossible to sell any of this product without hot swap.
And if you know him, you know how hard it is for him to stand on his head.
Well, we didn't get hot swap disks until the third generation of our products, which means we sold like $20 million of products before we did that. And you would not believe the song and dance that we had to use in front of customers. But when you're focused enough and a customer has enough pain with a traditional solution, you can convince them of a lot of things. And I think it's just another example of sort of having to think outside of the box that your incumbents that you compete against will put you in. And we sold without snapshots, a feature you talked about, for 5 years. Mm-hmm. It took us 5 years before we finally went and filled in that gap. We're now in 11 years, and we have a $500 million run rate as part of EMC, and I still don't have all of those features checkboxed. And it's not important, right? You do those, you fill those gaps in, but if you have enough advantages and you've built a product offering that is incredibly innovative and valuable to customers, customers get over it.
So now we enter a really interesting phase in the life of Isilon. So it's spring of 2003. The company is generating its first revenue. It's starting to ramp up its sales organization. We have an incredibly talented founding team. But the truth be told, we've been looking for some number of months for a CEO. The thought process was, and we were all in agreement with this, all in alignment on this, that we needed somebody who had seen the movie before in terms of building the go-to-market side of the organization out to really ramp up the business and grow sales dramatically.
That's code for Matt didn't trust a 26-year-old Yahoo from New Jersey. That's just
you might have been 27 at this point.
By then, maybe.
And it was a consensus. I think that we would all agree, and we were quite frankly struggling to find the right person. We had some people that ended up being great friends of the firm that ended up not being the right fit for that role. Jim Aber, somebody I think of most fondly. But we were a little bit, as a company, as a 50-person, first to revenue, complicated product. We were kind of struggling to get through that era.
We were, and this is we're not going to actually hire a CEO at this point in the story, but we'll tell you, we went in 3 search firms. These recruiters. When you hire exec recruiters, for those of you that haven't done it, you don't get to pay them when they succeed. You get to pay them up front, and then if they hire somebody, that's bonus. Well, we went through 3 of those firms. We paid them each $100K-ish.
And to be fair, that's the only time I've ever been through 3 firms.
But testament to our board and our team that we could say no to so many candidates because they just weren't the right fit, because it wasn't the right thing to do at that point. We'll get to hiring one, but we're not quite there yet in the story. 03 was a good year for us. It was a year where we got those first products off the ground. We certainly had some hiccups along the way. I don't know how many of you buy a 1.0 consumer product, but I try to stay away from it. I wouldn't have put my own digital photographs on our 1.0 product. And you
didn't tell me that at the time.
You didn't ask. Now you know what to ask. You didn't and we had some big problems along the way there. I think it was probably only 3 months in before we had to stop shipping our products because of a particularly nasty hardware problem. I remember sitting in a board meeting where one of our board members said, "Where are the orders? You're not getting you're not on plan. Where are the orders? Are you sure we really have the right product here? Should we go take all of our money and go do something else?" And
we entered a really interesting phase there, and on top of that, Laura, who we both adored, had decided to leave the venture business for a whole bunch of reasons. Her firm was going through a bunch of changes, and so one of her partners from the East Coast took over her board seat at that time. So we had
he was very green,
new guy in the kind of the boardroom dynamic. We had this product in the market. It wasn't as stable. In retrospect, primarily for some hardware reasons, but the software wasn't quite.
No, it wasn't very good yet
either. And we sat back as a board and we said, well, we kind of have 3 options here. One option is that we just keep plowing ahead and hope that we're going to sort this out. Another option was, let's assume we're not going to sort this out. Let's pull the product off the shelf, cut the team in half or more, and go back and get it right before we sell another $1 worth of this stuff. And there was the sort of middle ground option, which was we actually get the product off the shelf for a little bit, and the stop ship that Sujal refers to, try to figure out what is wrong with it and get it right, and in the process, at least cut 20% of the team, which is ultimately the path we took.
Yeah, and we cleaned up, we tightened up, and I remember one particularly fun board meeting was where we were starting to come out of it, and I had the sales folks slip a $200,000 order under the door. You'd be surprised how incredibly short-sighted VCs are. That alone just energized the room.
Pavlov dog, it's like, oh, we just got a sale.
And we got ourselves back on level footing, and the young companies often go and they figure out their path, and they find a good customer that really they form a symbiotic relationship with. And this was about the point in the story as we started getting into the third quarter of 2003, where we found a customer which we can affectionately call a whale, since for the next 3 years they accounted for about half of our revenue for 3 years straight. We were able to bend the product and really do what young companies do, which is get focused on figuring out how we land this large customer, building some custom features and functionality. I remember my co-founder, Paul, we had a release.
He was that customer's champion.
He was that customer's champion. We had a release that was supposed to come out at the end of November, and at the end of October, they go into infrastructure freeze for Christmas. So product has to be done if you're going to go and get it into their data center. You know, it was $500,000 or so. It was life-changing for a company at our scale. And you know, Paul did the unimaginable, right? Today, I cannot imagine going to a development team with 2 months left on the schedule, calling them into a room saying, hi, you have 1 month left. We're not going home. And that's what we did, because we had to get it out. And you know, it's that sort of drive that really creates young companies. We got that customer on board. We were in our 3rd CEO search, and finally...
Well, but yeah, it's a little bit, because that CEO search, I think, if I remember right, culminated in August. So I think this was sort of concurrent with that customer, because I still remember...
It is. We closed the first deal before you got CEO.
Because I still remember...
I did the hard work there.
Yeah, you did do the hard work on this one. So we had attracted the attention of a young, talented executive at F5, once again back to how the ecosystem matters. And I still remember Greg McAdoo from Sequoia and I taking him out to dinner, and this was kind of our final, you know, part sell, part assessment dinner, and we went to this restaurant, and you know, of course, as you would probably predict, you know, and he was fairly high profile at F5 at the time. You know, one of the board members from F5 is sitting 2 tables over, you know, who I know well, and somehow we finessed that whole evening. And then there was this meeting that we really presented him the offer, and we were going to close them, but we kind of thought that we might want to mention this little problem with the stop ship, and we're about to cut 20%.
That's right. We did do all that kind of concurrently.
And I think you got the pleasure of walking him back to F5 and telling him about it.
I did. And testament to him, he's like, okay, let's go do this.
It's going to be tough, but I'm going to go for it.
Yeah.
And Steve did a very, very good job in
Absolutely.
those years helping to build the company.
Yeah, and that actually, you know, we're gonna take the next, I guess, 04, 05, and 06 and really condense them. I think that those are interesting years, but not nearly the most interesting years in our journey here. You know, 2003 we ended up with a couple million of revenue. 2004, largely the same go-to-market focus. We built out our sales force. We got to about 7 million.
7, 8, yeah.
2005, we tripled that again to about 20 million, and this was about the point where we started to branch out, not just in 2 areas, but we went into some adjacencies. We went into life sciences, where there were large data volumes because science was moving from the petri dish to the data center, and everything was going digital. We moved into oil and gas exploration, which is a very data-intensive market. We went into some carriers and cable companies and a few other verticals, but we expanded a little bit. And 06 for us was another really good year off the backs of that expansion. You know, we got to a couple hundred employees as we started 2006. We ended the year at just around 65 million of revenue. And as we went through that year, we filed to go public, and in December, we
That's
went
an
public.
Interesting story,
Yeah.
you know, because so we had in 2004 we had raised a Series C, a group that's now called Sequoia Capital led that round. Then in early 2006 we raised a small, it was summer 2005.
You missed one in the middle.
And my Series D.
Series
Focus.
D.
Oh, you're right. I did miss that one, didn't I? Well, we raised a lot of capital.
We raised a lot of capital.
And,
By the time we got to IPO, we raised just over 80 million from the.
But every round was
venture
at successively
world.
higher valuations.
Yep.
I think the last round was
were.
at about a 325 million per
That's
year,
right,
if I
yep.
remember. And you know, the company was on a good trajectory. Now, the summer of 2006 was not a particularly great summer in the economy for a whole bunch of reasons. And we were sitting there, though, growing like gangbusters, growing from 20 million in 2005. We were on track. It looked like we were going to be north of 60 million. And you know, margins were improving as we grew that fast, which was another really good sign. You know, there's still a lot of operating losses, but we were at least heading the right direction in terms of gross margins. And so we entertained a group of investment bankers and had them tell the story of why they thought they might be best to help us, you know, consider a public offering. Now, being a public company, having been an executive in a public company long before I ever got into venture, was something I knew was entirely overrated. But it was an important step in the life of this company, and actually was something that made sense to do. And so we ultimately selected Morgan Stanley to be our lead banker. Merrill Lynch and some others were on the cover as well. But then we had three things that we needed to do in the fall of 2006. One, and most importantly, which was the only one that we could control, is to continue to execute on the business. And the team was doing a pretty darn good job of that. The second thing was the Securities and Exchange Commission. The Securities and Exchange Commission is who you file your documents with for a public offering. And they have a lot to say about that and the back and forth. And that's something you can semi-control. If you've got smart, talented lawyers, if you are transparent, if you think about the process as a process and you manage the SEC, you can actually get through that. Sometimes as quick as sort of 60 to 90 days, which we were able to do. And then the last thing which is the thing we had no control over, was the capital markets. And as it turned out, the capital markets went from fairly lousy in the summer of 2006 to almost incredible by the time we went public in December of 2006. And what I mean by that is a whole series of companies went public, companies like Riverbed and Acme Packets and Data Domain in this sort of wave, the public market window was open. And at the surface, you'd say, well, gosh, wasn't that great for you guys? We thought maybe we could sell shares at $8 a share, which would have been roughly twice the price we'd raised that last round at. And then it was like, well, gosh, we're seeing some things out there. Maybe we'll sell them at $10 a share. Maybe it'll be 11. Maybe it'll be 12. When we went public, the price on the initial public offering day was $13 a share, and it closed that day at $25 a share. And so we're sitting there kicking ourselves because we left money on the table, right? What were we thinking about?
Yeah, it was the best first day performance since the dot-com bubble.
Since the dot-com bubble. And in a lot of respects, you say, well, boy, that must have been great. That must have really helped you out. It probably was the worst thing that could have happened for the company.
Yeah.
You want to pick it up there?
No, this part gets a little painful. Why don't you continue for a few minutes, and then I'll take it from there.
So in retrospect, because concurrent with all this effort, you've got tons of executives in the company that are dealing with the preparations to go public. You've got lots of distraction. The company employees are thinking, wow, our name's going to be up in lights, up on the NASDAQ, and so on and so forth. By the way, did I forget to mention we were growing from 20 to 60 million? So not only would we have all kinds of scaling challenges in the sales organization, but we're continuing to have more and more sustaining engineering requests from our customers. We were continuing to try to innovate. We still had a long list of things, including snapshots that we hadn't built into the product yet. We were expanding into other verticals. We were expanding internationally. We were trying to scale our customer service organization. I can go on. And we had a CEO and a CFO and a VP of marketing and others that, for understandable reasons, were focused on other things. And that was a challenge. It wasn't really a challenge that showed up in 2006, but it was a challenge that showed up in 2007. And it's probably one of the biggest things you could kind of knock us for. I mean, and we talked about it some in that fall. We're like, are we really ready to go public as a company? And I think we thought we were, and maybe in retrospect we weren't. Because what happens in a public company, in addition to all the costs for complying with Sarbox and the complexities of it, is a whole new light is shined on you. And a whole new light is shined on the expectation management of what you do on a 90-day clock. Every 90 days, there's a new public communication of how well you're doing. And even though a financing of an IPO nature is a financing, it's not a liquidity event. It now creates a day-by-day, minute-by-minute metric, your stock price, of how valuable or not so valuable you are as a company. And it puts a lot of pressure on teams.
And that stock price is watched by your customers, your employees, their moods, how hard they want to work, go up and down with that price. It shines a huge light on the company. And as you can guess by our setup here, so we went public, first day closed at 25. I think we got up to 28 or so.
There might have been a day or two there.
A day or two up there. We were planning on, we told Wall Street we would get from 60 to 120 million. We'd grown 3x for 5 years straight, so we thought that should be easy. Internally, we set our bar at 143 million.
And that was a battle, by the way, to not communicate what we thought we were going to do internally and to communicate a lower $120 million expectation.
Yeah.
Which was, that's another good lesson of, expectation management, that here's a company that actually in 2007, if I told you, here's a company that grew from $60 million to $90 million in 2007 and improved its gross margins, expanded in a bunch of different verticals, you'd say, gosh, I bet the stock went up. Nope.
So, so let me speed through the next few quarters.
Yeah,
we got
go
to
right
Q1. We got to Q1. We reported our results, and our results were disappointing to Wall Street. And by this point, after we reported those results, the stock must have bled down to $16, something along those lines. We sat around as a management team. We said, okay, we were just a little short. Let's bang out a great Q2.
But actually, they hit their numbers, but they had missed the whisper numbers. So it's always like an expectation management game. It was the thought process was.
And whisper numbers are set by what was the velocity of the stock price? Well, if it's double the IPO price, then it must be doing great.
Right. So there's sort of this self-fulfilling
value. That's right. Yep.
Prophecy and perceived value.
Yep.
And to be fair, we partly were responsible for that, right? We had a team that did a great job of going out and selling the story and setting a level of expectations and enthusiasm. I think we all thought we could get to the 120 at least, and we were wrong, and we paid the price for it.
Yep, that we did. So we're at $16. Keep an internal counter in your head; it gets good. We got to our Q2. We hunkered down. We told Wall Street that we were going to do revenue between X and Y, and we posted results that were kind of leaning towards X, the lower side of that range. And Wall Street was extremely disappointed with those results, given that we'd put pretty conservative guidance out there. By that point, the stock had fell into 8, 9, or 10, somewhere in that range.
10.
All right, let's call it 10. I remember 8 or 9.
It might have been.
Somewhere in that range. And we as a management team hunkered down. We haven't talked about it yet, but when we hired a CEO, I took over the CTO role, which basically meant I had a great role. I'd get on an airplane and go fly around, and I'd go convince customers to buy our products. And I'd go and build relationships and help guide the company's strategy, technology, and so forth. And so I've been on the management team and the board basically constantly for the last 3 years that we've had a CEO. We sat down and said, boy, what do we have going on in this business? And we knew we had a few issues, right? The products were creaking a little because we were growing so fast, and we weren't able to hire great people to build the new features fast enough. We may have gotten a little ahead of ourselves and branched out a little bit too aggressively. Our support organization might be creaking because we're growing really fast. We thought that our sales productivity was about a quarter behind. We just quite weren't getting as much revenue per head count within our sales organization. So we convinced ourselves we were a quarter behind. Yep. And we sat around a room before a board meeting and we said, okay, let's set the bar just low.
As low as it possibly
low as you can for the second half, so we know we can easily clear it and get on the right foot with Wall Street. And we put together a plan that we thought that was gonna would accomplish that, and we put it in front of the board. The board approved it. We went out and started tackling our Q3.
And missed.
We got to the end of our Q3, and not only did we not clear the bar that we had set that was incredibly low, we did not even get to the bottom end of the range that we had told Wall Street that we would get to. And when you miss your range, you don't wait to earnings. The minute the quarter closes, you get on the phone, you say, we screwed up. And when we said that, the stock fell to about $5.
Yeah.
So now we've gone in the course of 9 months from about $28 to $5.
Yeah.
And our board scratching their head a little bit, trying to figure out what was going on and why we're on the wrong path. I was trying to do the same thing. I was on the board and a member of the management team. One interesting thing happened to me around mid-year, which is that my wife was pretty pregnant with twins. And so my wings got clipped quite a bit. I was spending a lot more time at home. And so I spent a lot of time trying to really analyze our business and understand what was going on and really why we were missing. And that investigation led to a set of conversations with the board. Maybe I'll let you pick it up since you were part of all those conversations.
Yeah. No, there was a whole series of conversations about why are things breaking, why are we not scaling well, and what are the degrees of freedom of things we can do about it. And I think that combined with the fact that then the company in Q3 missed. And then there was a little bit of issues around, which ended up being at least externally facing big issues. I mean, it's a matter of public record. Well, were we even accounting for our revenue quite the right way? See, there's this temptation when you are trying to please Wall Street to count everything that could possibly count as revenue for the quarter. Not that it isn't a real dollar of revenue, but the accountants keep score a certain way. And so there were some sort of off-invoice promises being made to customers. Yeah, you could swap that out later and all. And that's pretty hard to know. It's pretty hard to know even if you're the head of the audit committee. I wasn't, but it's hard to tell. And so there was some signs that might be a problem as well. And so the decision was to let both our CEO and our CFO go, and to ask Sujal to step back in as the, I think it was an interim CEO, or
yeah, you gave me
the full title.
You gave me the full title. You made the CFO interim.
Yes, that's right. Bill was the interim CFO.
He ultimately deserved the full CFO title,
and he earned it.
Yeah.
Sure did. But so now we go into 2008 with having grown from 60 to 90, $5-ish share price, and a investigation into our accounting.
Well, hold on, we have to paint a full picture.
Oh, okay.
So October 23 of 2007 is when you handed me back the reins of the company, and you gave me an interim CFO who had been with the company for 9 months and had never had any responsibility like this before in his life.
Director level of finance at Amazon, who would come over to be our VP of finance.
No, he was still our director or controller. I mean, it was.
Did we get the VP title?
We did at that point, but a huge mess. And with the accounting irregularities, if I get my words precise, that we had found, we went to Wall Street right before our earnings and said, "Here's what we're doing. We fired our CEO and CFO. We've replaced it with this young guy from New Jersey. And we've got an interim CFO. Don't worry, that doesn't mean anything, but we can't report our results right now. Can't report our results. So we're just going to cancel the earnings call, and it'll be okay." About 4 or 5 days later, we did file an 8K form informing Wall Street that we've launched an independent investigation into some accounting irregularities that we have uncovered potentially. And about this point is the point where, I'm in the job 5 days at this point, and I have a whole company of people who probably brush off their resumes. I have every one of my competitors walking around with a piece of paper, which is the press release that they're going to be delisted from NASDAQ, we're delinquent on our filings, we can't get our accounting right, telling all of our customers that there's no way that you should buy anything from Isilon ever again. You've got a set of accountants and lawyers that cost millions and millions of dollars working through our accounting irregularities. Incredibly tough time for the company. And my first day as CEO, again, in October of 2007, was get down to our C-level, bring the whole employee base together, sit there and tell them nothing other than, we haven't been doing things as good as we know we can do. We're going to do better. And, I'm the guy who's going to help you get there, and really tell them nothing else, and send them off, and
do their jobs the best they can.
Do the job as best as you can. You finish that meeting, and by this point, I have a list of customers, employees, and I start making phone calls. I spend the rest of my day making phone calls, one to the other, customers, partners, and employees, one after the other, making sure that I have every one of their commitments, that I've been able to connect one-on-one, that I've got the emotional tie so that they feel like it's going to be okay. I mean, it's a shepherding process of emotions for employees. Yeah. And, of course, T-minus 1 month, my wife's going to give birth to twins as well. So it's a bit of a trying time for all of us here.
A little stressful.
I think it probably took me, 90 days to make a strategic plan for the company?
Maybe a little longer, but
maybe a little longer.
February of 2008.
And here was the strategic plan. I'm going to try to paraphrase. You can fill it in for me. Strategic plan. I'm not going to get any sleep because I now have twins. Maybe just around the beginning of 2008. Part number 2. We've stretched our products too thin. They're unreliable. And really the only way out is for us to invest more. Yes, I know, Matt. I took over at negative 37.5% operating margin. But we're going to have to get a little worse before it's going to get better. Trust me. That's the strategic recommendation.
We have about $80 million in cash in the bank.
Yeah.
But we know we're going to have to burn some of that.
Oh, yeah, we're going to burn. Yeah. And I got lots of speeches around, when you have a J curve, a curve that keeps going down and then comes back up, those almost never work out. But that was strategic part of the plan number one. Part of the plan number two was that we were diffuse. We started building too many products. Our market focus was too wide. We had to cut down from 7 things we were doing to 5 things. It wasn't even a week in before I killed my first product. It was about the time of the strategic plan. We killed our second product, got the company more focused. And then there was number 3, which was I look around the table and at my exec staff meeting, and I'm not really sure that the people who got us here are the right people to take us forward. And when I say people, I mean almost everybody at the table for various reasons. We'd outscaled, or we don't have the right person,
They're just burnt out.
Or that's exactly right. In the case of a number of folks, they're either burnt out, or because of the stigma of what had occurred with the accounting irregularities, just from circumstance standpoint, they've lost the confidence of sects of the company, and we just have to we have to move on. And so I brought that to the board. I don't even remember how long we deliberated and thought about the plan, but we eventually said yes.
And things then got actually, I think, harder before they got easier.
They got much harder.
Because 2008, as you I'm sure remember, was a pretty difficult year in the economy. That first part of the year, right about then, we were kind of taking these hard decisions. Let's invest more in the product quality, narrow the focus, burn some capital, change some team members. But we were doing it in a pretty good macro economy. I think it was March. I mean, we'd already taken that decision. It was March when Bear Stearns, fell off the face of the earth.
September of 08.
And then it was September of 08 when Lehman Brothers, of course, did. So that was a really, really tough year. And I think it was a year, the other thing I would say is that, for all the many good things that the team we had in place had done to get to that point, there was a little bit of a mindset of we can grow our way out of problems. And what that leads to often is you lose what had been one of the hallmarks of the company. And even though we'd spent a lot of capital, we always had this culture of frugality. And the importance of knowing that every dollar, even if you have to spend a lot of dollars to get there, is going to demand a return at some point, had been lost in the company. And I think that was one of the most important cultural things that you restored in the company in that year.
Yeah, I mean, that wasn't part of the strategic plan, but culturally we had lost our way. People weren't focused and passionate like they weren't used to be. They weren't frugal, right? I mean, you'd have someone in the sales force stay at the Four Seasons, right? And we very quickly and very definitively refocused the company, refocused people. We had you talk about frugality, we had a contest to see who could stay at the cheapest hotel rooms. And a guy who's been with us now for 11 years, who runs marketing for us now, eventually won that contest, but gave up at that point because he felt like there were bugs in the room. He had to stop. It was a motel in Minnesota that was like $49 or something. It's we really actively had to work to recreate the identity of the company while we were swapping out pretty much every executive team member. So
I've never heard about the Sam and the bedbug story. That's
it's a fun story.
So let's fast forward.
By the way, he couldn't sleep there. He ended up getting another hotel room and changed. But
so we want to be sensitive to time and all.
Yeah.
I think it's worth fast forwarding because I think there's one more interesting story in the laying the groundwork for the recovery, which is another hot swap you did in Q1 of 2009.
Yeah, but before we get there, let's just say by this point we've replaced every executive on my staff except 2 at this point. And then we replaced 1 more, and 1 survived through acquisition. 1.5 survived, you're right. So, yeah, okay.
Okay.
It was ifs and nets, but
anyway.
you're right. But you're right, you did. But go ahead. This is a good part.
So it's interesting because now and there were some terrific folks on the audit committee and all that took charge of this investigation, worked all the way through it, figured out in aggregate that about $6 million had been recognized in the wrong period, and so had to restate a set of earnings for 2007 so that we were in compliance with the way that the accountants keep score. And so we came out of that. We made that announcement. It's now February of 2009. If you remember, this is when the stock market's gone down to like below 7,000.
Our stock was at 2, and just under 2.
$1.86.
$1.86 was.
And so the stock's at around 2, and a lot of people are scratching their head. Is this company on the road to recovery? The company had actually grown revenues in 2008 which given that the storage industry shrunk in 2008, it was really a heroic achievement. And so those of us that were kind of on the inside got a sense. Now, of course, I'm in a venture firm, to bring it back to the venture world for a second. And so we've got our investor base, and we own still 16, 17% of the company. And so now that this investigation's behind us and whatnot, we kind of ask the question, what should we do? What should we do with our shares that we own? Where's our conviction about the company? And just to put it in a little bit of context, $2 a share on 65 million shares outstanding is about $130 million market cap. And we had 75 million in the bank. So we basically had a $50 million net of cash, enterprise value. That's like going back to 2003 in this company.
Yeah.
But yet we've now over 100 million in revenue. There's a lot of signs that we're starting to gain momentum again. And we'll come up to this one last key move that was made on the team front. And interestingly enough, we did the analysis at Madrona. We went out in the open market and we bought shares, which is just not something an early stage venture capitalist typically does. But we were like, at $2 a share, this is a buy. And you're allowed to buy in certain windows if you're on the board. And that window of February 2009 was one that it was the window in the middle of the quarter where we could buy. So we bought some more shares. And we were glad we did. But we did that, and I knew full well that we had a guy who was running our sales. This is, our guy that had built this to a certain level was one of those guys that because of all the what happened in the revenue recognition, it was just, even if he didn't do anything wrong, it just kind of needed to move on. We had another guy running it. He was the wrong guy. Came from one of the big companies, had a great big company sales kind of style to him, panache, sheen, if you want to use a word that... Slick. But he wasn't operating the sales organization the way we needed to. And so you and I, had come to a conclusion, the board had too, but it was really Sujal, that we needed to make a change there. And so we launched, which I'm not a big fan of in general, but it was the right thing in this case. We launched a stealth search for a replacement of our senior VP of sales.
Which is hard since salespeople are like schoolgirls. They just talk constantly. So it's actually quite a complex thing to do a stealth sales search.
And we had these dinners. We've narrowed it down to 2 people. One was based here. One was not. One had a lot of storage industry experience. One had a lot of systems related industry experience. And we ultimately convinced a guy named George Bennett to step in and be the senior VP of sales. And so concurrent with the end of the quarter, we did a hot swap of sales executives. And that was now, the spring of 2009.
Yeah, and just another case of, of perseverance, right? George Bennett's a guy I met years ago. I didn't have a sales job open, but when someone as qualified as he does contacts you out of the blue, which he did, just cold, of course you take the call, you build a relationship. It wasn't until 2 years later I called him up out of the blue and said, "What are you doing?" He's like, "Hey, I just took a job. This is January." He took a job in August. I said, "Well, you don't really want to work there. You want to work here." And I eventually caught up with him. I don't remember where, but he travels 52 weeks a year. So I caught up with him somewhere, and I just started convincing. And by the time we got to April, he was on board. And you just have to keep grinding away.
That was one of your best sales cycles ever, I think.
Yeah, it was a good sales cycle.
That was a good one. And funnily enough, so I think we should fast forward a year.
Yep.
And so
we should just talk about what the results of 2009.
Yeah, so the results in 2009, 125, right?
We barely grew, but we grew.
Yeah.
So we grew single-digit percentages, but it was an awful year for the storage industry. Every major vendor was shrinking during that year. The economy was in awful shape. IT spending was not in good shape. But we kept grinding away. We barely grew the business. And by the time that we got to the end of 2009, we posted a Q4 where we were just barely break even at that point.
Yeah, and the combination of doing better than the market and actually for the first time ever showing that we had a break even, slightly positive quarter, the stock market, some of those sort of fast money hedge fund guys at least, started paying attention to the stock again. Nobody paid attention to the stock in 2009. And the stock started to creep back up to about $5 a share by the beginning of 2010.
And it was interesting. We took the opportunity in January to go to New York after our earnings to ring the NASDAQ bell to commemorate the closing and really announce that we actually had breaking even and we're not a bunch of losers. And by that point, we were the only. It was a huge down day. And we were the only stock on the big board, on the NASDAQ market site board that you could see that was up, and we were up to like $6 at that point.
Okay, there you go.
And it was the beginning of a pretty big turnaround. For us, 2010 was an absolutely phenomenal year, and one that I don't know I can replicate again in my life. By the time we got through Q1, a few things had occurred. One, they had occurred simultaneously. One, the economy and IT spend was really on the path to recovery. George Bennett had been in that sales chair for a year and really had replaced a huge majority of people in the organization, had gotten the structure, the process in place, and really had the business humming. We had our products and technologies working well. We had our support organization working well. We had a team of folks in there that senior folks that were doing a good job, and frankly, the market had matured, right? We've now 8 quarters, we've been in recession or close to recession for 8 quarters. The market was finally starting to move in our direction, and when we got to Q1 of 2010, we were able to put up a quarter with 45% year-over-year growth, and really now, a few percentage points of operating margin in the green. We had a good quarter. By Q2, that growth rate was up into the 50% range. By Q3, it was at around 65%. And the business was just on an absolute tear. Q4 for us, which we never reported because we were acquired in Q4, would have been an 80% growth quarter and a 20% operating margin. So now we're talking about from when I took over at negative 37.5%, an operating margin swing of nearly 60 points. If you back up, as soon as you start doing that well and the stock price goes from 5 to 6 to 10 to 12 to 15, you start to attract the attention of some of those large companies that you're beginning to beat. And at this point, we were at a run rate of, good bit north of $100 million, heading towards $200 million. And for those of you that know EMC decided that they wanted to talk to us, and they used the classic, they're based in Boston, so they used classic Boston style. They left a voicemail on the company's general mailbox.
Hi, we're coming out to Seattle to visit Microsoft. We'd like to stop by and get to know Sujal Patel. By the way, never talked to the guy in our lives before. Never met him before. And this was on the general freaking mailbox of the company.
Not just that, they said, we're bringing the president of the Unified Storage Division with us.
We'd like to meet him and see if we can maybe work something. Now, the 2 other things that are interesting here. So one, our direct competitor, which is this company NetApp, which was beating EMC in the market pretty handily in this so-called mid-range storage area. NetApp had called us every now and again, too, and said, if there's ever an occasion where you're thinking of selling, we would love for you to give us a call. So we knew we had that little dynamic that they were always kind of making sure we were aware of through one person or another. And then you had this EMC piece. Well, the other thing that we, as a board, in terms of strategy in 2010 had said is, look, we have this pretty good momentum going now. We can see how we're going to grow through 2010. We could probably see how we're going to grow through at least the first half of 2011. But eventually, we're going to need some pretty interesting leverage points, partners probably, to be able to get what we were calling the second double of growth. And so we were actually open-minded to exploring certain types of go-to-market partnerships at this point. And so the EMC call, we decided, okay, well, let's take the meeting and let's try to turn it into a real interesting partnership.
The other thing we realized as a company at this point was that what was a very interesting and novel idea a decade ago was becoming the norm that the storage industry will adopt from an architecture standpoint in the coming decade. And we realized that if the whole storage industry was going to shift architectures, how were we going to get $10, $12 billion of run rate reasonably on a path of even doubling year over year? Because doubling year over year, it's going to take you a while just to get to the middle of the decade, just to get to $1 billion. And so we were looking at ways to enhance our distribution and really be able to capture that opportunity.
Because what the EMCs and the IBMs and the HPs have of the world is they have account control. They have Fortune 500, Global 1000 account control, and they're pretty good at using that account control as leverage to get money to their bottom line, even if it's not the best-in-class products, or they're reselling somebody else's best-in-class products, or they're buying companies to do it. And so concurrent with the momentum in Q2, and then the announcement of Q2 earnings, which was in July, and then the stock is now up at like $15 a share, EMC and us are trying to explore as their partnership. And I think we're pretty quickly coming to the conclusion, no, it's probably not going to work out as a partnership. And they're pretty quickly coming to the conclusion, we'd really like to buy this company. And so it's sort of classic, actually. They called up and said, we'd like to have a meeting in late August. We got some people that want to come out and talk about strategic options, code for acquisition. And we kept saying, well, let's look at all the options that are on the table. And so that meeting got set up. And then through one of our friendly investment bankers, the folks at NetApp called up and said, you know, is there any chance? Now, keep in mind, this was an era where 3PAR, some of you are familiar with this company, 3PAR, there was this very public battle between HP and Dell over who was going to buy 3PAR, and there was some bankers involved and whatnot. Well, this was driving the storage stocks all up somewhat, and it was making EMC more nervous that they needed to do something. It was making NetApp even more nervous because NetApp had $2 billion in the bank and EMC had $10 billion in the bank. They knew, they meaning NetApp, that if really we got into play, there was about no chance that they would be able to outbid one of the other big boys.
Yeah, and NetApp was also stung. For those that follow the history of the tech industry, in 2009, NetApp made an offer to buy a company called Data Domain, and they made a nice fair offer. And they announced the deal, and EMC came over the top with a hostile offer, topping NetApp's. NetApp topped that offer, EMC topped again, NetApp topped again, EMC just kept going until they won. And they literally took the deal straight out of NetApp's mouth and embarrassed them. And so they were very, very wary of that happening again.
And so in this context, eventually, EMC did make an offer to buy the company. And this is, again, all a matter of public record, so you could, if you wanted to dig into the bowels of statements that get filed when companies get bought, you could see all this. They initially made an offer to buy the company for $27 a share. So, $27.50. We hadn't seen $27.50 since like 2 days after the IPO. This is a long, long time ago. And it was actually a pretty easy decision to say no. So you pick it up there.
Well, and it's interesting. We at this point, we've had a conversation with folks at NetApp, and we've kept in touch with other potential companies that have interest in us. We looked at $27.50, and we said, look, there's a lot more value in what we've built, the technology that we have, and the momentum that we have. And there was a long, lengthy board discussion, but we turned around very quickly after that and we said, no, we like our independent plan. We thought you were talking about partnership. Now you're putting an acquisition offer out here. We're just not.
We're surprised.
We're surprised. We said all those sort of things. Acquisitions are a game of poker. When we knew who was coming to visit us in August, we of course would call our friends at NetApp and say, hey, probably a good time to catch up. Turned out that actually got scheduled on the exact same day, and so I was on an airplane down to Silicon Valley, met the CEO of NetApp, took off again, landed, had dinner with folks from EMC, all on the same day. It was an entertaining day for me. So I knew that we were onto something here. We said no, and
so we said no. We also hired 2 bankers. We hired our friends at Morgan Stanley, who'd been our general counsel kind of bankers for a long time, and we hired the very best in the industry from an M&A perspective, a guy named Frank Quattrone and George Boutros, who have a little boutique shop called Catalyst. And together, they were our advisors as we dealt through this process. And what was important about that, and part of the reason we hired both of them, was we wanted to signal to EMC into the market that we were plenty comfortable remaining independent. And quite frankly, it turned out that really what EMC was bidding against was our conviction to stay an independent company. NetApp was gun shy, and they knew they would lose, and they probably ascertained, not that we had told them, that EMC was somebody else that was out there bidding for the company. And so the saga played out over the course of the fall, where we said no after doing all of our math and figuring out what might be a range that we would be potentially open to saying yes at. And they went away and they thought about it for a while. They came back and they said, okay, how about $30? Starts with a 3, could be enticing. And what's really interesting is Sujal says these games, and I was the head of the M&A committee, and so Sujal and I spent a lot of time strategizing on this, and of course with the bankers and the board and all, but there's a lot of art. I mean, every single move you make in an M&A process matters. And sometimes it's designed to annoy the potential buyers. Sometimes it's designed to draw them in. Sometimes it's designed to give them an impression of something. including, I remember they flew out a group of people to do some due diligence. Do you remember this?
Yeah. Okay.
Sunday afternoon, and they had promised us they would agree to certain things in exchange for coming out to do due diligence. And we had said no and forced their hand, and they'd agreed to 90% of the stuff we wanted.
Well, yeah, and the final issue was around a standstill, which is essentially we will engage in this diligence and give you access to our IP to evaluate, but you, for a certain period of time, will not make a hostile offer in the public markets, which we know EMC has done in the past. And you know, it was funny, right? We had a bit of who's on first. What's on second type of game with one guy would say, yes, we're going to do that. The next guy would say, no, that person doesn't have authority. And we'd go and we'd finally get on the phone with their chief deal maker, a guy named Harry Yu, and we were fighting with him on the phone. And essentially he was dragging his feet and said, well, let's get started and let's sort this out. And so we basically hung up and made the entire team of people, which is probably 12 people, sit in the lobby of our offices. We gave them newspapers, and they didn't sit there. They sat for hours until we were coming close to cracking, and we just kept procrastinating, and eventually they just called up.
Then Gary called back and agreed.
Yep. There you go.
And the point of that was, you know, again, you're not trying to be a jerk about it, but you're trying to establish a credibility to the boundaries around which you're engaging. And that became important all the way through the process. What was interesting is there became this momentum in the deal around if we're going to do a deal. And at this point, you know, they had offered now 30. This is October now. And we had done one of these, have the banker go and tell them that, you know, I don't really know what the board's willing to take. If it was just me, I guess they maybe would take something like 37, but I'm not really sure. Kind of trying to kind of put a number out there. So that was sort of the gap at that point in time. And then there was this momentum and documents and things seemed to be going forward, and we both wanted to announce the deal.
From here, I mean, you know, one of the things that was interesting in this deal process was, and this has happened with a number of high-profile deals recently, is that there were press leaks, that there was interest, there were press leaks that EMC was going to acquire the company, and so EMC was not only competing against us, but competing against the press disclosing what's going on, which made them extremely nervous. You know, we told the banker to go out and say, well, maybe we take 37. And
then we formally said the board would take 36.
Formally told them the board would take 36. And eventually there was some leak. And, well, I guess eventually at this point, by this point, the bankers had sort of kind of narrowed and said, well, maybe we can meet in the middle at around 33.
So we have this board meeting on the...
Well, we got this agreement on those. Yeah. We're heading towards an earnings report, and it's a good report. And because the Dell 3-par HP war, storage stocks are on fire. So we basically told them, you know, hey, look, you don't want to get to earnings. Here's what they look like. You want to get this deal done, you better give us that price now. And they all said, yeah. And we got merger documents done, and...
They called up and said the deal's off.
On the...
Tuesday.
No, Wednesday. Right?
Was it Wednesday?
Wednesday.
Yeah,
The day before.
yeah, their earnings were on Tuesday.
Yep.
That call was on Wednesday. And our earnings were on
Thursday.
Thursday.
My car, my extra jeans and clothes were in the car because I was going to be there all night. Nope. They called up middle of the afternoon. There's no deal. And
we look forward to staying in touch. So what do you say then? What do you do? Do you say we'll take 30?
No.
No? I mean, you know.
What I said?
Yep. Well,
I said, Harry, thanks for telling us. We're going to go back and have a great Q4, and when you call again, we will start this over because that price is no longer valid. Goodbye. Hung up the phone.
Yeah.
I called my team up and said, you after people wasted your time for the last 3 months. Get back to work.
and you know, and there would have been a couple other things that had happened in the interim there. I mean, we I had insisted that you go out and meet Joe Tucci. Sujal hadn't met the CEO of EMC yet. And so that meeting had happened, which actually turned out to be a really important meeting just in building a face-to-face relationship.
Joe and the head of the M&A
Head of the M&A committee.
The head of the EMC's family company, the head of the M&A committee is the son of the founder of EMC. And so it's extremely important to build those relationships so they know what they're getting into, and we know who's on.
And that was on the Friday before the call, the Wednesday after, which was the deal is off call. So then nothing happened. We kept building our quarter. We actually were having a great Q4. And a couple weeks later, they said, you know, well, they had some storyline about how we needed to meet some other senior executive, which we did. Then we heard nothing. And then there was a certain Friday in
Yeah,
November.
and which, by the way, you know, that was actually a conversation we kept to M&A committee,
Yeah.
the board, and myself and one other unmanaged
Yeah,
leader.
because we didn't want to distract the executive team.
And we didn't tell the bankers because there have been so many leaks, we decided to keep it to an incredibly small group, not knowing where any of these.
Generally not a good sign that you don't trust your bankers, but at any rate.
I won't say anything. And so that story goes on. We get in 4 more weeks here. Quarter's looking good, and Friday morning.
12th of November.
12th of November, Friday, I was thinking 2 weeks before Thanksgiving.
Yeah.
Friday morning, Joe Tucci's assistant calls me up on my mobile phone and says, "Hi, what's your fax number?" And I said, okay, maybe I'll give you the legal fax number. So I gave the legal fax number, and then she calls my assistant an hour or 2 later and says, "Hi, Joe would like to talk to Sujal at 1:05 Pacific time." And I'm like, okay, great. It's a very specific time to schedule a meeting.
That would be 5 minutes after the market
Or
closes.
5 minutes after the market closes. And Joe Tucci calls me up and says, Sujal, we're at a crossroads. We're going to do this deal. It needs to happen right now. When it gets to Monday, if there's a leak, we're dead. There's no deal. We got to do it. And if you don't do this now, you're going to hear about another deal next week, and we're going to Plan B. And he gave me the speech, and he said the price is $32.50. Of course, the handshake was $33 earlier. The price is $32.50. And so I did what good CEO would do. I told him that I have a fiduciary obligation to take that to the board, but I tell you now, the answer is no. And he pauses for a second.
I think you also said, I'd be happy to tell you more about how our quarter's going.
Yeah, but I don't think.
That was that night. That was that night.
Yeah, maybe later that night
Yeah.
we actually disclosed to them that we had received already in the quarter a $10 million order from one of the top 10 brands in the world. And this was the beginning of a huge engagement, and you guys don't know how great this quarter is going to be, blah, blah, blah. And, that was actually an interesting tidbit because, I now know in retrospect there was a lot of tension at EMC between the M&A committee and management between the price of the deal because, what the ultimate price that was agreed to was the highest multiple paid for a data center storage company of revenue up to that point. So EMC was paying handsomely for the company. But eventually we took that to the board, and the board said, well, we're going to say no. Mm-hmm. And then in their second breath, they told me, but don't you lose this deal, Sujal. And
I think we said that anything above $33.50, but we would be willing to accept.
Anything above 33.
Was it 33? I meant $33.50, but anyway.
And so they gave me the power to call back the next day on Saturday and go hammer out a deal.
Yeah.
And
I think you had a conversation with Joe and Harry that night.
Yeah.
And they said they said we're going to give you stuff to think about. You're going to give us stuff to think. And Harry called you the next morning.
Harry calls next morning and
says
he says we can do $33.50. I said no way. We need 34. Of course, the board's already told me don't lose this deal at 33. He's at $33.50. Harry and I start arguing. We argue for a long time, and Harry tells me that
34 is not doable.
34 is not doable. I've been negotiating for $27.50. I said $27.50. We would never take it $27.50. I feel like I said 37, now 36, now 34. And we argued, and he tells me at some point, oh, we can't pay that. You have to make us look good in this process.
You said something like,
in the middle there, he tried to get me to split the middle. Hey, let's do this. We've only got a bid-ask spread of 50 cents, so let's just work on this through the weekend while we get the merger going. I said, no, we don't get off this phone until we're done. He goes, then split it down the middle. And I said, no, to split it down the middle. And eventually he goes, I can't give you 34. And I said, well, what can you do? He said, you tell me. And so I made up the fictitious price, $33.85, which is how we got to this odd number.
that was the price.
It may seem like I'm quibbling with $6 million from 75 to 85, so it's a lot of money. And we got the deal, we finished up on the deal, and from there it was pretty uneventful. And
Yep, it's announced on Monday morning, and it was done in a month. And what's really cool, bringing it all the way back to the Seattle ecosystem, and then we'll shut up because we've gone on probably far longer than we should have, is the company has grown dramatically here, and lots of people have been hired. And what's that?
I blame you.
And that's been really, really good for the tech innovation economy. Joe Tucci was out here this past fall and spent a bunch of time, gave a keynote address at the Industrial Affiliates event at the University of Washington, met with a bunch of startups, some of which had spun out of the university. And these are really good things for helping, take Greater Seattle to the next level, and obviously really good things that, that these guys built a really significant and valuable company, and a lot of folks, broadly in the community, including some folks that are here in the room, were a part of making that happen. So.
Yeah, and ultimately we made, we're only 13 months in, but, EMC may have paid $2.5 billion, but it seems like EMC is getting its money's worth. I mean, one of the things EMC does a phenomenal job of is buying companies and turning them into huge successes. VMware, Data Domain, RSA Security, and the day of that conference call that Joe announced the deal, he told Wall Street that we would be at $1 billion run rate within 24 months. That's the first time I heard of it. That suddenly became my goal, and I can tell you now, just like Joe said on the earnings call just a couple of weeks ago, that Isilon's well on the way to hitting $1 billion run rate from 220 the year that we were acquired to 10, something along those lines, just in the span of 8 quarters. It's phenomenal, and it's what makes EMC successful. The company did about $20 billion revenue last year. It's up almost 20% year over year, which is impressive for the company of that scale. So it's been an incredible ride, and one that I'll never forget. I'm sure you won't. And it's great for the Seattle economy, and hopefully we can be an innovation engine just like many other companies were over the course of the next decade here.
Thank you.
Thanks.
If you're not completely bored and exhausted, we can probably take about 5-10 minutes of questions, and we've both got to get to a dinner. I know we are a little long-winded.
Can I ask a quick question?
Yeah.
So of these 200 or so the cutthroat competitors that you start off with, how much of you coming out as a survivor of that to your technology being versus your marketing sales play there?
So out of those 250 storage startups in that era from 1998 to 2002, about somewhere between 5 and 10 of us survived to accomplish anything of significance, and only really 3 or 4 or 5 made it to the public markets. Data Domain, Isilon Systems.
And then Panasys is still sort of lingering around.
There's some lingering around, but
Blue Arc got bought by HDS, and Spinnaker got bought early by NetApp.
So very, very few made it there. I think that in order to have survived in this industry, odds are not good. It's a combination of technology, market fit, customer focus, and then as well just teams that are incredibly tenacious, right? There are a lot of cases in Isilon's history where we could have just said, boy, we made a good go of it, let's just call NetApp and see what they'll buy this company for. And that was the path of a lot of those storage startups, but it's all of those things that go into getting to where we eventually got to.
In the final analysis, what value did Frank Quattrone bring to the deal?
So I will, Frank we pay Frank a lot of money and then we give him commercials. So, Frank Quattrone and George Boutros did a phenomenal job on our deal. And we actually had a team of folks between Morgan Stanley, myself, and Quattrone's team that actually played different parts in the process, right? Morgan Stanley was our back channel and our company advisor telling us why we should never sell this thing. George Boutros, if you know his reputation, is the guy who would get on the phone with EMC and scream at them for hours about why the price is too low and why you're never going to get it at this price. That's sort of his MO. And I was the one who, when they were fed up talking to him, they told us never to let him in the room again. I was one who took over the negotiation.
Back channel to me through one of their board members. I think that there's a number of places that investment bankers can add value, and part of it is in some of the blocking and tackling of helping you really think through a 5-year projection that's more refined and more sophisticated of what you can credibly say as a board, this company could be worth in 5 years. So you've got some level of benchmark of if we stay independent, what's the value that we can create? So that's part one. Part two is the overall strategy of, okay, how are we going to respond to this interest? Part three is, you don't want to reach out to all the other people and do a market check, which you have to do pretty rapidly, You want to have an agent, as it were, that's going to do that, at least in terms of getting those, sort of positioning it and getting the assessment of, is Dell interested, is IBM interested, is NetApp interested in the deal? And so that's an important role. And then there's also this role of being both the annoyer, but also being the interpreter and helping us strategize about how to go back, in different points along the way. What I would say is that at the end, it's about principals negotiating and reaching an agreement. And so at the end, it was Sujal talking to Joe and Harry that was important. The bankers don't really love that, but it is the reality. So they add a lot of value. They get paid an incredible amount of money. But if the principals don't do their jobs, it's unlikely that it's going to be successful.
Yeah, and I think in the best M&A outcomes, ultimately principals how it has to be worked out. But bankers are an important part of the process, and we love both the teams that we have.
Thank you, guys. When you talk about that restructuring that happened 2007, 2008 time period with your executives, you said you kept like 2 or 1.5. How many of those were guys, Sujal, or gals, that you had brought on board versus your executives, the CFO, CEO that you'd fired?
So out of those folks, really just two were mine from originally, so they go back before 2003, and the rest were brought on by our former CEO. And so, part of that process is,
Were those the 2 that were kept?
No.
Oh, okay.
No,
Wow.
I kept
Sort of 2.5, actually.
Yeah, I've been the math there.
Yeah.
So, it's kind of, the math gets odd because some of those folks weren't on the exec team, but were promoted up from within our ranks to the exec team. But needless to say, it was a huge amount of shake-up. And in that process, you have to sometimes have tough conversations with your friends who you would go into battle with again because time and circumstances just aren't right anymore.
Yeah, that's the point that I think is important. It doesn't make somebody a good person or a bad person. It's a lot about fit for that season in life of the company. And
not just that, but when a company goes through as much trauma as we described, a lot of things go wrong along the way, and you have to make a clean break a lot of times and just start over again.
Sure. Maybe 2 more questions.
This is more a question for Matt. For the startup companies, for example, if you have a good technology, you have a you have the customers, for example, but how can you build a winning team in case you're lack of that?
Well, I think Sujal talked a lot about this idea of understanding what is your culture. And I used to be, I remember when I was in business school, I hated this class, organizational behavior, and they were like, all this soft stuff. But
Sounds like a Harvard class.
I know it does. But the culture and having a vision of what you're trying to accomplish and kind of a core set of things that you stick, right? That's a really important part, and it's so under-focused on early in the lives of companies. And I've seen over and over again that the companies that take the time to focus on that have a high, there's luck involved, there's market timing involved, there's a bunch of other factors, some of which are really not in your control. But you have a higher probability of success. Another local company here that, really, that I've had privilege to work with since its founding is a company called Aptio. They overinvest in this area. They just are, and not only from a culture perspective, but part of their culture is being transparent. And this idea of, and I think this is something that Sujal helped to bring back, because it was probably part of the culture that we lost in a season of the company, is this level of transparency. If this is really something going right, this is really something going wrong. I mean, how hard it is to make decisions when you don't have accurate information is really, really difficult in a company, especially in a company that's in a new, emerging, ambiguous space. So I think having a culture, acting consistent with that culture, and particularly a culture that has a high degree of trust and transparency makes a real difference as you're growing and scaling a business. Believe me, it gets harder as you get bigger, but it's super important to invest in.
So last question, I guess. You told about the story where the Wall Street was really unhappy with the results, with the accounting discrepancy. How easy was it, or how hard was it to bring back the confidence for the Wall Street?
So bringing back the confidence of Wall Street was incredibly difficult. we had two sets of issues. One was a credibility gap that was caused by us missing our guidance over and over again. But two was just a set of investors who looked at the issues we had in accounting, were burnt with the stock, who didn't want to hear the story anymore because they may have invested at 28 and had to go down to 3 where they sold it. It was a process that took us years to rebuild that confidence. And probably our stock price didn't start turning when our metrics started showing, because we had to prove it even more to Wall Street. And that's one of the reasons why the stock had such a steep upward trajectory in 2010, was that by the time Wall Street had seen the results were really starting to turn around, it took a lot to get over that bar with Wall Street.
Yeah, just to add a little bit more color on that. So it was Q3 of 2007, right, when we made the change, and it was Q4 of 2009 when we actually first turned a profit. And I think that was the quarter that Wall Street started to say, okay, you've now said for 3 or 4 straight quarters that you were going to do something, and you beat it, and you raised our expectations for what's going to happen in the future, and then you beat it again. We're starting to believe in your story. And now you're actually profitable, so you're taking away this whole risk that you could run out of cash at some point. And then the company, of course, continued to execute throughout 2010, and then you had certain kinds of. I'll tell you, the other thing is the investors, these venture guys, not just us, but the others as well, holding the vast majority of their shares, and then actually, as I mentioned, buying shares in the public market was a signal to the public market that we believed in it too. And so I think that probably helped. But remember, that was in Q1 of 2009, so it was more than that needed to happen.
Yeah, the last thing that helped was consistency. We were fortunate enough to have good advisors, good board, good folks in communications, one of them who's here now, who always kept the company's message consistent through some very tough times. And so we just reinforced over and over again to Wall Street, here's what we're doing, here's the plan, and we're sticking to it. And that consistency helped a lot to rebuild the confidence.
We have to unfortunately run to a dinner, so we can't hang out longer. But thanks for your attention, and for hopefully this was an interesting story, and you have a few takeaways from it. Thanks very much.
Thank you very much.